In the last 3 years, if you had invested 10 lakhs in a Nifty IT ETF, today you would have made approximately 12 lakhs. That's 6.7% compounded annual returns. That same 10 lakhs in a Nifty infrastructure ETF would have become 19 lakhs. Almost doubled your investment, giving you a 22% compounded annual return. But here's the truth that you probably don't want to hear. For most passive investors, sector investing is the wrong move. Because by the time everyone is talking about the theme, the maximum return from that sector has already been made by early investors and they're on to the next big theme. I'm CA Vamika, and by the end of this video, you'll know first how the Indian economy moves through four distinct phases and why different sectors win in different phases. Second, why thematic investing is a trap for most passive investors. And third, which phase are we in right now in 2025 and what that means for your money. Before we dive in, please do subscribe to the channel to not miss the weekly actionable and practical investing deep dives. Okay, let's dive in. Before we talk about which sectors are doing well today, we need to understand that the economy doesn't grow in a straight line. It moves through four distinct phases, and each phase creates different sector winners and losers. Once you see this pattern, you'll understand why chasing themes is so dangerous. Let me break down the four phases of any economic cycle. In each one, there are four major players: the central bank, the government, corporates, and consumers. Phase 1 is recovery. The economy is coming out of a slowdown or a recession. So GDP growth is slow in this phase. Corporate earnings are barely growing and they're cautious about their spends. Consumers stick to essentials. Banks are ready to lend, but nobody is borrowing. So RBI cuts interest rates and governments give tax incentives to boost the economy. Which sectors win during this phase? FMCG, pharma, utilities, which are the defensive plays. Okay, phase 2 is the expansion phase. Now things are heating up. GDP jumps to 7 to 8% or higher. Corporates start borrowing to expand. Profits are improving fast. Customer confidence is also high. And they start spending on cars, electronics, travel. Credit is flowing due to low interest rates by RBI. Government is also pouring money into infrastructure projects. Sectors that usually do well during this phase are banks and NBFCs, which benefit from credit growth. Infrastructure and capital good companies, due to government and private capital expenditure on roads, ports, power, real estate and consumer discretionary also start picking up. Next phase is the peak phase. The economy is still growing, but warning signs are flashing. Growth is strong, but starting to slow. Raw material costs start rising as demand for commodities needed for infra projects increases. Corporate valuations start looking stretched as everyone is euphoric. Credit growth is very high, sometimes leading to poor lending decisions by banks and NBFCs. RBI tries to cool things down by increasing interest rates. Overall, the market sentiment will be high. Some commodity sectors benefit from high prices of metals and industrial raw materials. But this is often where risk starts building. Phase 4 is slowdown or contraction. In this phase, growth starts decelerating or turns negative. Corporate profits will be disappointing as consumers' demand starts reducing. Credit growth slows down and NPAs might start appearing. Interest rates will be high from the previous tightening by RBI. This is when markets correct and panic sets in. And we'll be back to the defensive sectors such as FMCG, pharma, and utilities. Post slowdown phase, the cycle starts all over again. The RBI will start cutting rates, government might give tax incentives to push for recovery, and so on. Let me show you how the different phases played out in the last 20 years. From 2005 to 2008, the GDP growth rate was great at 8% plus in all the years. Infrastructure was the central focus, growing at 20% plus. Roads, ports, power plants being built everywhere. But 2008 global financial crisis crashed the party. From 2009 to 2013, everything slowed down after the 2008 crisis. Infrastructure projects faced delays, but the safe, boring stocks, FMCG, pharma, were the only ones showing growth. Another phase, 2022 to 2024, IT started cooling down as global tech spends normalized post COVID. But infrastructure was heating up at that time because government was investing massively in rail, road, power, ports. So, do you see the pattern? Sectors take turns. They don't all win together. Different sectors lead based on where credit is flowing, where government is spending, and what the overall macro economy looks like. Before we see which sectors are currently picking up, let's see whether you, as a passive investor, should invest in sector or thematic ETFs or not. If you are someone who has a full time job, doesn't want to actively track market cycles every quarter, and wants to build wealth over 15 to 20 years without stress, then my answer is clear. Instead of thematic funds, stick to market cap based ETFs such as Nifty 50, mid cap ETFs, or flexi cap funds from proven fund houses. Why am I saying this? Because thematic investing requires you to time two things correctly. First, when to enter. Ideally, the time to enter would be when the theme is out of favor and the valuations are very cheap. Second, when to exit. Ideally, when the theme has played out and just before the theme starts going out of favor. For a passive investor with a full time job, it's quite difficult to time sectors and keep a watch on which sector's valuation look favorable. Let me prove this point to you with two examples. Let's look at the first example of the timing trap through IT sector. Suppose in December 2021, you saw IT stocks are at all-time highs. TCS and Infosys at 38 times price to earnings, when the historical average is around 22 times. And everyone around you is saying digital transformation is the future. And you agree with the logic without looking at the valuation. So you invested 10 lakhs in an IT-focused ETF in 2022. Today, 3 years later, you would have roughly 12 lakhs. But if you'd invested that same money in a Nifty 50 index fund or ETF, you would have around 15 lakhs. Why did this happen? Because you entered when the theme was expensive. The theme itself wasn't wrong, but your timing was off. Next, let's look at the second example through PSU Banks. Scenario A is you got the timing right in early 2021 when PSU banks were hated. They had high non-performing assets, governance issues, and everyone was avoiding them. For context, SBI was at price to book of 0.9x when its historical average is 1.4x. BOB was at a price to book of 0.5x when its historical average is 0.8x. If you understood that the NPAs would normalize moving forward and banks were trading below book value, you could have invested in a PSU bank ETF at that time. By 2024, that investment would have given you 2x return. But suppose you missed the 2021 opportunity. By now, everyone's talking about PSU banks. You feel FOMO. You invest 10 lakhs in a PSU bank ETF in 2024. What happens next? Maybe some more upside of 1.3x. But the easy 2x is done now. You're now entering at elevated valuations. Do you see the problem? Thematic investing works only if you can identify themes early when they are unloved. Stay invested through volatility and exit when the valuations peak. The three important requirements of investing in sectors are: first, deep sectoral knowledge. Second, know the valuation of the sector to be able to time your entry and exit. Lastly, emotional discipline to buy when everyone's pessimistic and ride through the volatility till the theme plays out. Most passive investors don't have the time or sector knowledge to be able to meet these three important requirements. This is exactly why in my January 18th, 2026 webinar, I am teaching goal-based investing that doesn't require you to time sectors. More details at the end of the video. A lot of people think thematic funds are the middle path, not as risky as picking individual stocks, not as boring as index funds. But here's my honest view. Thematic funds are highly cyclical and you need to time it accurately. That is why they are not an effective middle path. One important note before we continue. When I say thematic investing, I'm specifically talking about thematic ETFs that you control. Why? Because thematic mutual funds have a major limitation. They are mandated to keep investing in their themes, regardless of timing or valuation. That's why they significantly underperform market cap based index funds over time. With thematic ETFs, at least you can control when you enter and exit. Now, if you're an active investor who has studied a sector deeply for years, can understand the sector cycles and more importantly, the valuations, then yes, you may consider sectoral exposure. But even then, I would suggest to have a long term view to be able to ride the ups and downs till you feel that the sector has become expensive and it's time to exit. The mathematical way to time, if at all you really want to, is to check if the PE is low compared to this sector's historical average, and check if the earnings growth has slowed down but is likely to pick up in the future due to something favorable happening for the sector. My honest recommendation is that the boring path wins. Market cap based index ETFs and good active funds are great compounding machines. Over any 15-year period, this boring portfolio would easily beat 60 to 65% of actively managed funds and almost all thematic funds. More importantly, market cap based index ETFs already capture the companies and sectors that are doing well. Example, Nifty 50 has 36% of financial service sector, 10% IT sector, 7% of auto sector already captured. The index automatically rebalances themes by increasing or decreasing weightage when the cycles turn based on the free float market cap of those sectors. So instead of riding the volatility of sectors, we should ride the volatility of our chosen index ETF and continue doing regular SIPs no matter what. I've discussed this in detail in my previous video. Make sure to check that out after this one. It will change the way you think about timing your entry and doing SIPs. Okay, so where exactly are we in late 2025, early 2026? Firstly, it's difficult to predict precisely as the economy is going through its own phase while sectors are going through their own individual cycle. But let's look at the macroeconomic factors first to get a sense. India's real GDP growth in the second quarter of financial year 25-26 was a strong 8.2% year on year, which is 2.6% higher than the same period last year, indicating robust economic momentum. For the full year 25-26, real GDP growth is projected at 7.3%, which is supported by low inflation and GST rate cuts. In October 2025, consumer price inflation declined sharply to around 0.25%, which is historically the lowest in over a decade. This provides RBI further space to keep repo rates low at 5.25%. Looking at macroeconomic factors, the Indian economy seems to be in the second phase of economic growth. India is growing at a high GDP growth rate. Corporates have started reporting good earnings. Consumer spends on discretionary has started increasing due to low interest rates by RBI and tax cuts by the government. Infrastructure and capital goods sectors have been on a robust multi-year expansion, majorly driven by government investment on roads, railways, power and renewable energy. But government expenditure on capex and infrastructure has started reducing in the last 1 to 2 years as it wants private companies also to share the load. And the government is spending on tax cuts and giving money in the hands of the end consumer to keep the economy growing at high single digits. So it's difficult to know for sure which sectors will capture the momentum, as sectors also have their own mini cycle. But some experts are predicting banking, consumption, and auto sectors to be the beneficiaries in the near future. Please note that this is not a recommendation. This entire video is only for educational purposes. If you're enjoying this video so far, I have something even more valuable coming up for you. I'm hosting a live webinar on Master Your Money with Goal-Based Investing on 18th of January 2026. In this webinar, we'll deep dive into how to plan SIPs for long-term goals such as retirement, children's education, and financial freedom. Second, how to calculate the right investment amount by factoring in inflation and taxes so you never fall short of your goals. Third, how to build an investing approach that helps you feel stress-free, secure, and confident about your financial future. This will be a practical and action-packed 2-hour session where I will share my goal planning calculator sheet and we will work on it together live so you leave with a clear and personalized roadmap. The feedback from my previous webinar was amazing, and many attendees said that they are excited to join the next one, which makes me even more thrilled about this webinar. Please note that this is a paid webinar. The registration link is in the pinned comments. Do check that out. Okay, to conclude, quick recap. The economy moves through 4 cycles: recovery, expansion, peak, and slowdown. 4 players drive these phases: the central bank, government, corporates, and consumers. Within these macro cycles, sectors have their own mini cycles. That's why timing them becomes tougher. For passive investors, it's best to stick to market cap based investing and avoid thematic investing altogether. Lastly, for active investors, thematic investing makes sense only if you deeply understand the sector and can time your entry and exit based on valuations. In the next videos, I'll be going deep on 2 sectors experts say that are going to pick up: banking and consumption. I'll show you the exact valuation metrics that I am tracking and whether now is the time to enter or if you're already late. If you want the detailed playbook, do subscribe to the channel so you don't miss the upcoming videos. If this video helped you decide whether thematic ETFs are for you, then do hit like, share it with a fellow investor, and do subscribe to learn about more actionable investing strategies. Thank you for watching. See you in the next one.